Now, the type of journals that are very important in our accounting records. So I'm going to discuss all the journals, but the ones we are focusing on in this learning unit is just your cash book receipts, cash book payments, and your petty cash journals. Now you'll see I've given the abbreviation. That is the abbreviation you use when you do the journal folio number. You do not use a different abbreviation. It will be marked incorrectly. Okay, now our cash book shows how our bank increases. So it basically shows us the money we've received physically in our bank account. Now our source documents is on the right hand side. You will see it's a duplicate cash invoice or duplicate invoice. Now the reason for that is generally our cash receipts come from our debtors. Now we would have given the original documentation to our debtors when they pay us or when they bought goods from us. So that's why we have duplicates when it is our customer. When we look at the cash book payments, that's now when I pay my suppliers. We will actually have the original. So it will generally be original check counterfoil, the EFT. It would generally have their original creditors invoice as well, because of the fact that we are paying our suppliers. So we would have the original documents in our books. Now, your cash book payment shows all your transactions that would decrease your bank. So that's money that's flowing out of my bank account. Petty cash journal, we said petty cash is a little box I've got in my office. It's got cash in it, and I use that box of cash to pay for small expenses during a month. We normally use it when we buy tea or coffee in a business. You will give 200 Rand to the person. They will go to the shops, they will go buy the tea and coffee, they'll bring back a receipt and the change, and then that will be reconciled at the end of the day to make sure that the money that went out and the money that was spent and then the money returned actually reconcile. So they equal. That no. Now your petty cash journal looks very similar to your cash receipts journal, but that is just for your smaller receipts. But your petty cash journal is generally small expenses that I pay. They look similar to your cash book payments as well. The only difference is we do not have a folio number or additional folio number column like we do for the cash book payments journal. When we do the example, I'll show you guys that again. Then you've got your creditors journal and your creditors allowance journal. Now your creditors journal shows all the purchases you've made on credit. That source documents your general credit invoice. Creditor allowance journals is where I've returned any things or I received a rebate, so a discount from my creditor, and I show that in the creditors allowance journal, and that's generally associated with the original credit note. Debtors journal is my customers. That is where I sell trading inventory on credit. Okay, and that is generally your duplicate credit invoice. And then debtors allowance is if I've given them any rebates or any discounts, or if they've returned any of the goods, I would show it there. General journal is our journal where we include any items that does not relate to cash, does not relate to credit, and we would then account for it there. So that is, for example, any interest that was charged on an account would go to your general journal. If I have a debtor and they no longer able to actually pay me, then I would also show it in the general journal. Okay, so as we start doing more of these transactions, you will get a feel for these different journals. But for now, you just need to know that there are 7 types of journals and which ones do we use when. Now, for this session, we're going to focus on question 4.3, but we're only going to do this third part of it. The other part you can do for homework because that takes way too much time and you have to physically go through all the source documents that's provided. Now, what I want you to do is in my textbook. It's on page 105, so I'm assuming it's in the new textbooks on page 108. Can someone just confirm what page number do you have for this question? Okay, so it is page 108 in your textbooks. So what I want you to do is read through the information. Now, what we need to work out in this session is they asked you to complete, okay, so it's page 109, correction. They ask you to complete the table, the following table in order date. So they've given you a table that has the date, the document number. Then they ask you, is the document an original or duplicate document? They ask you for the journal number. Now that is the journal abbreviations. That is your journal reference. Then they ask you what account is debited, what account is credited. So you remember that is the accounting equation. Those account names you will find on page 50. I think it's page 50 where you have your, and then you need to show how does it impact my financial statement categories, assets, owners, equity, liabilities. Now, if we read the main paragraph or the intro paragraph on page 109 in your textbooks, you'll see Omega Traders, a computer retailer, entered into the following transactions during June. The business is a registered VAT vendor. Now, the fact that they tell you they're a registered VAT vendor, a little red flag needs to go off. You need to know that you have to account for the VAT when you do that accounting equation. So you remember in Learning Unit 2, we didn't take VAT into consideration. Now they've upped the ante, they've added the VAT component, which we learned about in Learning Unit 3. What you have to do is you have to distinguish between whether it's input VAT, output VAT. So remember we said output always goes with revenue or income, where input goes with your expenses or your assets that you've purchased. Okay, output VAT, because I have to pay it over to SARS, I owe them money, is a liability. Input VAT, because I get money back, is an asset. Okay, so just make a note for yourself when you do the accounts that you know which one is an asset, which one's a liability. Then they tell you they only trade with other registered vendors. Now, why that's important is if you do not trade with a registered vendor, you're not allowed to claim the input VAT. So what they're telling you is for the expenses, for the assets, you are allowed to claim the input VAT if it's allowed. Okay, and then they tell you they use a perpetual inventory system. Now remember, perpetual inventory system, we said, is the inventory system where we take the inventory initially to our asset account, and then when we sell it, we take it out of assets and then take it to cost of sales. So that is where we've got our 4 entries. So that's the other thing you had to note. And then they tell you all goods are marked up at 60% above cost. So that means we're using a markup percentage, which means our cost represents the 100%. So our selling price would represent 160%. So you can see just from that first paragraph, you had to see that you have to account for that. You have to account for the markup percentage. Okay, Mapaledi, what I'll do is I'll have to scan it. I don't have a like projector here. So what I'll quickly do is I'll scan it and then I'll share it while you guys can start with the question. Okay. Or is there anyone that can take a photo and just share it on the WhatsApp group maybe for the guys that don't have it? Okay, so for the rest of the guys, can you please just start with the questions? I'm going to share the Excel spreadsheet in the format that it's supposed to be, and then I'll quickly scan this while you guys then start going through the information.